The volatility, the counterintuitive rhetoric, all of this stuff, that's all part of what they've done forever. And as the stakes get higher, so too will the volatility, and the ability for those to hang on will be less and less and less. Don't let go. Don't sell your metal. That's all I can tell you is that this is not over, not even.
You're watching Silver News Daily. Subscribe for more.
Silver just delivered one of the most confusing signals investors have seen in years. After smashing through the historic $100 level and igniting excitement across the precious metals market, the price suddenly dropped nearly $10 in a violent correction that left many investors asking the same question. Was the rally over before it even began? At first glance, it looked like panic. Headlines started appearing everywhere, suggesting the silver breakout had failed. Traders who rushed in during the excitement began dumping their positions, fearing they had just bought the top. But behind the scenes, something very different was happening. Something that experienced investors and major players in the physical metals market understand extremely well. Because when silver drops sharply during the early stages of a major bull market, it often isn't a warning sign. In many cases, it's the opportunity that smart money waits for. And that's exactly what Andy Schectman has been warning about. According to him, this sudden $10 drop isn't a collapse at all. It may actually be the moment long-term investors have been waiting for. The kind of moment that only appears a few times in an entire market cycle when volatility shakes out the weak hands and creates a rare entry point before the next leg of a much larger move. Think about where we are right now. Silver has already done something many analysts thought would take years. It broke through the psychologically powerful $100 barrier. That alone tells us something extraordinary is happening beneath the surface of the market. Metals don't break major historical levels like that unless powerful forces are building behind the scenes. But here's the part most people miss. In major commodity bull markets, the path higher is never smooth. In fact, the early stages are often the most volatile. Prices surge higher, excitement builds, and then suddenly the market pulls back hard. Enough to make people question everything. This cycle repeats again and again, shaking out traders who are chasing quick profits while quietly rewarding the investors who understand the bigger picture. And that bigger picture right now is what has seasoned investors paying very close attention. Because while the price chart might show a dramatic drop, the underlying fundamentals of the silver market have not weakened. In many ways, they've actually become stronger. Physical supply remains tight, demand is rising across multiple industries, and investment interest is beginning to accelerate again after years of being largely ignored. So the real question isn't why silver dropped $10. The real question is why so many experienced investors are suddenly doubling down while the rest of the market is hesitating. Because if the forces building behind silver are as powerful as many experts believe, this sudden pullback might not be a warning sign at all. It might be the quiet moment before one of the most explosive moves the silver market has ever seen. And once you start looking at what's really happening beneath the surface of this market, you begin to understand why some analysts are making predictions that sound almost unbelievable, including the possibility that silver's long-term trajectory could be far higher than anyone currently expects.
As far, yeah, look, I mean, the drawdown was crazy, no question about it. You know, you look at a few things that have precipitated these drawdowns. You talk about the Bloomberg headline that ran cover for the paper smash, as far as I'm concerned, where they said Russia was going to jump back on the dollar standard. And this precipitated forced index selling, and along with the margin hikes and the dumps by the algos or the algorithms that run everything. And when they start to see selling begets sellings. And in a fraction of a second, you saw $3.5 trillion erased. And then quietly, the report comes out that says Russia is on record saying they're not going back to the dollar standard. Yet that day, Bloomberg pumps the opposite narrative, and that's the news. You know, that's the positioning news that we get. It's almost like they're running cover for it. But when you talk about what's happening right now in the silver market, look, we're 10 days away from the first notice day of delivery for the March silver contract. And I think people really need to understand what this means. As of Friday, there was 58,770 contracts that were left open interest, as it's called, that could stand for delivery. Each contract is 5,000 ounces. So that's 294 million ounces open interest right now for the March contract. A bunch of it has rolled to May, to the May contract, because there was about 400 million ounces a week ago. So about 100 million ounces have rolled to May, which is the next big delivery month, not April, it's May. And that's normal, right? But it's still really very huge that we have 300 million ounces open this close to first notice. So I think what I take away from that is not a COMEX default, but even half of the open interest actually decided to stand for delivery. You're talking 150 million ounces that would need to get sourced, right? The problem with that is that the registered silver category, that is the available silver backing the contracts available to deliver, is about 90 million ounces, right? So
The emotional whiplash in the silver market right now is unlike anything most investors have experienced before. And that's exactly why so many people are misreading what just happened. One moment, silver was breaking through the historic $100 barrier, a level many analysts believed would take years to reach, and suddenly the market turns and drops nearly $10 in a matter of days. For someone watching from the outside, it looks like a disaster. It looks like the rally failed. But if you study how silver behaves during major bull markets, this kind of violent swing is not unusual at all. In fact, it's almost expected. Silver has always been one of the most volatile assets in the entire financial system. When it moves, it doesn't move slowly and politely like many other commodities. It moves in powerful bursts that shock both sides of the market. Prices surge rapidly. Excitement spreads. New investors rush in thinking they're witnessing the beginning of something historic. And then just as quickly, the market pulls back hard enough to shake their confidence. This cycle of excitement followed by fear is a pattern that has repeated itself again and again throughout silver's history. If you look back at previous major rallies, you see the same emotional roller coaster playing out every time. During the 2011 run toward $50, silver experienced multiple corrections of 10 to 20% along the way. Each drop convinced thousands of investors that the rally was over. Each drop triggered panic selling, and each time the market eventually recovered and pushed even higher. The people who understood the pattern held their positions. The people who reacted emotionally were forced out of the market right before the next move. What makes the current situation even more dramatic is the psychological impact of that $100 milestone. Round numbers have a powerful influence on investor psychology. When silver crossed that level, it wasn't just another price point on a chart. It was a symbolic moment. It signaled to the world that something extraordinary might be unfolding in the precious metals market. But markets rarely allow the majority of participants to profit easily from those moments. Instead, they create volatility, uncertainty, and confusion. This is where the divide between short-term traders and long-term investors becomes very clear. Traders focus on the chart in front of them. They react to price movements, headlines, and momentum. When the price drops sharply, their instinct is to get out as quickly as possible. But investors who understand the deeper forces driving the silver market look at the situation differently. They ask a completely different question. Instead of asking why the price dropped, they ask whether the underlying reasons for silver's rise have actually changed. And right now, that's the critical point. Because while the price chart shows a sudden correction, the forces that pushed silver above $100 in the first place have not disappeared. In fact, many of them are still intensifying. Economic uncertainty continues to drive investors toward hard assets. Industrial demand is growing as new technologies require increasing amounts of silver, and physical supply constraints are becoming more visible in global markets. So the emotional reaction we're seeing right now, the fear, the confusion, the hesitation, is exactly the kind of environment that tends to appear during the early stages of a powerful bull market. It's the moment when weaker hands begin to exit the market, while those who understand the bigger picture quietly position themselves for what could come next. And once you understand that dynamic, the $10 drop begins to look very different. Instead of signaling the end of the move, it starts to look like the kind of reset that often happens before a market prepares for its next major push higher.
Reporting requirement. There are no laws to confiscate metal. And I'm not sure why these things are being propagated other than to say maybe it's in an attempt to get people to abandon ship. For that reason and that reason alone, I don't even watch the other ones. When I get this information, it's not very difficult for us to fact check it. We do, and find out that it's not really true at all. So bottom line is there are no new laws surrounding confiscation or reporting or 1099 or Form 8300, like all of these various Asian AI channels have said. And the reason that I say OG John AG is the only one that I have followed, he's gotten several things right. The one thing that he got right before anybody, literally before anybody, was talking about what was happening with the refineries being logjam because of the margin increases, and got that right. There are a lot of things he's gotten right. The one thing that I don't like about any of these channels, any of them, him included, is if you're going to say something about a leaked memo, at least show us the memo. You can redact as much as you want, but if you have the memo in your possession and you're talking about leaked memo, the one thing I was disappointed about was that they had talked about HSBC being forced to leave the silver market and cover all of their short positions by the end of January. They had talked about Morgan Stanley and JP Morgan, both leaked memos. All three were leaked memos, but those two in particular also, Morgan Stanley and JP, saying that they were going to leave entirely the futures market. So look, with any of these channels, you have to, I think, listen, take what you want out of it, but do your best to fact check it, to do your due diligence. And look, that's the one thing that I'm forced to do and you're forced to do 7 days a week. We spend all this time trying to gauge what's happening in the market. And I find OG John AG to be a valuable source of information, but still, and I think he would agree, or whoever's behind that channel would agree, that, no one gets it right all the time. You need to, and I was on Adam Taggart, and I misspoke. I talked about a regulation, and I thought it was the Genius Act, but it was actually the Bitcoin Reserve Act. And I came back on, I said I was sorry, I got it wrong. No one gets it right all the time. Do your due diligence. And the things that are really freaking people out, to my understanding, none of them are true. And I've done my best, not only through our operations, but also through my own due diligence to validate none of that stuff is true at this point, as far as I can tell.
And to put a little context to what you were just talking about a few moments ago about comparing the Magnificent Seven performance to silver, for example, which has been
When silver drops suddenly like this, most investors assume something has gone terribly wrong. But in reality, sharp corrections after a major breakout are often the result of very specific market mechanics, rather than a collapse in the underlying story. To understand why silver fell nearly $10, we need to look at what typically happens after a historic price milestone is reached. The first driver is simple profit-taking. When silver blasted through the $100 level, it triggered a wave of buying that had been building for months. Early investors who had accumulated silver at much lower prices suddenly found themselves sitting on massive gains. For many of them, the move past $100 represented the perfect moment to lock in profits. So, naturally, a portion of those investors began selling. When large holders take profits all at once, the market can drop quickly, even though nothing fundamental has changed. The second factor is the leveraged trading environment that dominates modern commodity markets. A significant amount of silver trading today is not happening in the physical market, but through futures contracts and other leveraged instruments. These positions allow traders to control large amounts of silver with relatively small amounts of capital. The problem is that leverage cuts both ways. When prices start moving down, even slightly, leveraged traders begin receiving margin calls. That forces them to liquidate positions quickly, which adds even more selling pressure and accelerates the drop. This creates a cascading effect. The initial selling from profit-taking triggers small declines. Those declines trigger margin calls. The margin calls force leveraged traders to sell, which pushes the price even lower. Before long, the correction begins to look far more dramatic than the original cause would justify. What started as a normal pullback quickly turns into a sharp move that scares investors who are watching the market from the outside. There is also a psychological component that amplifies the move. When a market breaks a major milestone like $100, it attracts a large number of late buyers. These are investors who didn't participate in the earlier stages of the rally, but rush in once the breakout becomes obvious. Unfortunately, these late buyers are often the most sensitive to volatility. When the price pulls back suddenly, they are the first to panic and exit their positions. Their selling adds another layer of downward pressure, pushing the market further into correction territory. But here is the crucial point that experienced investors understand. None of these factors reflect a breakdown in the fundamentals of the silver market. Profit-taking, leverage liquidations, and emotional selling are short-term forces. They affect price movement in the moment, but they do not change the deeper structural dynamics that drive long-term trends. In fact, corrections like this often perform a very important function. They remove excess speculation from the market. When speculative traders are flushed out, the market becomes healthier. It resets the momentum, allowing stronger hands to take control of the next phase of the move. This process has happened repeatedly throughout the history of commodity bull markets. Violent pullbacks shake out the weak hands, clear out over-leveraged positions, and prepare the market for a more sustainable advance. And that's why many seasoned investors are not alarmed by this drop at all. They've seen this pattern before. They understand that the most powerful rallies rarely move in a straight line. Instead, they move in waves, with each correction creating an opportunity for those who recognize the bigger forces at work beneath the surface of the market. Because while the price action over the past few days may look dramatic, something else has been happening quietly in the background of the silver market. And once you start looking at the physical supply situation, you begin to see a signal that many investors completely missed during this correction.
Let's be fair. I mean, it's not the volatility, Dunnigan, is not just relegated to the precious metals. How about the not so magnificent 7? So far in 2026, you have Nvidia down 2%, Google down 2.5%, Meta down 3%, Apple down 6%, Tesla down 7%, Amazon down 14%, and Microsoft down 17%. This coincides with the strongest retail equity flows ever on record. But it's important to understand that when you talk about volatility, over the last 8 sessions, 115 of the S&P 500 stocks have fallen at least 7% in a day, right? That's an internal breakdown, and it's happened only 1% of the time over the last 30 years. In particular, the index itself is only down 2.5% off its highs, but you have 115 stocks moving 7% in a day. And historically, when this happens, you're looking at a 35% drawdown, then last seen since 2000. So, when you talk about volatility, it's not just in precious metals, first and foremost. I mean, look at crypto. There's volatility everywhere right now. This is a period of upheaval. This is a period of uncertainty, and it's not just relegated to precious metals. And before I talk about what's happening in the precious metals market, I mentioned the other day on a few shows, look, there's all these Asian AI channels. The only one that I have followed that I found to be accurate or ahead of the curve more so than most anyone is the OG John Agee. The rest of them I don't even watch anymore because of things like that. Things like these rumors that are not true whatsoever. There is no February 15th.
Just before we get going, we just launched the official Silver News Daily Telegram. To kick things off, we're running a 10-ounce silver giveaway. Yes, real physical silver, not a voucher, not digital credits, actual bullion. This Telegram will be our new home for real-time silver discussions, market insights, collection picks, and everything precious metals. It's where the community truly comes alive. Here's how to enter the 10-ounce silver giveaway. Be subscribed to Silver News Daily on YouTube. Turn on the notification bell. Comment 10-ounce giveaway on 3 separate videos. Be an active member of the Telegram group and say hi. Once we hit 500 active Telegram members, we'll pick one lucky winner to receive 10 ounces of silver shipped directly to you. So get in early, stay active. What many investors completely missed during this sudden drop is what's happening in the physical silver market. Because while the paper price was falling on trading screens, the underlying supply situation remained extremely tight. In fact, one of the most important signals in the entire silver market right now has nothing to do with daily price movement and everything to do with physical availability. Behind the scenes, major trading hubs have been dealing with persistent supply pressure. Physical inventories are not as abundant as many people assume, particularly in key markets like London, where large portions of the global silver trade are settled. When investors, institutions, and industry all compete for the same limited supply of physical metal, it creates stress in the system that doesn't always show up immediately in the spot price, but that stress continues building beneath the surface. And this is exactly the environment the silver market has been operating in for several years now. The fundamental balance between supply and demand has been tightening steadily, creating a structural deficit that continues to shape the long-term outlook for the metal. Even as prices fluctuate in the short term, the deeper supply picture remains remarkably strong. In fact, analysts expect the silver market to remain in deficit again this year, marking the 6th consecutive year where total demand exceeds total supply. That means the world is consuming more silver than it is producing through mining and recycling combined. When this happens year after year, the market is forced to rely on existing above-ground inventories to fill the gap. Over time, those inventories begin to shrink, placing even more pressure on the physical market. This is a crucial point because commodity markets can tolerate deficits for short periods, but persistent deficits eventually force prices higher as the market searches for equilibrium. If demand keeps rising while supply struggles, to keep up, prices must eventually adjust to encourage more production and limit consumption. That's simply how commodity markets function. And despite the dramatic correction we just witnessed, the forces driving silver demand have not weakened. Investors continue to accumulate physical metal as economic uncertainty remains elevated, and geopolitical tensions continue to push capital toward tangible assets. At the same time, industrial demand continues to grow as silver plays an essential role in many modern technologies. So while the $10 drop grabbed headlines and created fear among short-term traders, it did absolutely nothing to change the deeper structural pressures building in the silver market. If anything, it revealed just how fragile the balance between supply and demand has become. Because once you understand that the market has been running a supply deficit for years, the conversation shifts dramatically. The focus stops being about daily price swings and starts being about something much bigger. The real question becomes how long the market can continue drawing from existing inventories before those reserves begin to run dangerously low. And when you start looking at the numbers behind that deficit, you begin to understand why many long-term investors are becoming increasingly confident about silver's future.
Ever. I mean, let's go back to the pandemic. Premiums on junk, we were paying $9 over spot for 4 years. Anyone that would sell us as much as they would sell us, we would pay $9 over spot. I've never seen a market like this, and it's not just junk silver, although that's been hit relatively hard on the buy side. It's all of the items with the exception maybe of silver eagles. I've never seen anything like it. Let's talk about it a little bit. In an effort, I think, by the CME group to, which is the COMEX, to knock the speculators off their perch, they raised margins significantly. So normally we'll have 2 or 3 million ounces of silver in our warehouse, and we will hedge it ounce for ounce so that we're market neutral. We'll sell the equivalent of what we have in our warehouse on paper. So one goes up, one goes down. We've talked about this a lot. So you're market neutral with your inventory. If a week or two before Christmas, it was about $16,000 to hedge 5,000 ounce contract, somewhere in that neighborhood. Now it's about $50,000 to hedge a 5,000 ounce contract. And gold is about 40 some thousand dollars to hedge a 100 ounce contract. You have to have that in your margin account. And as long as the market doesn't move against you, it stays there. Well, you know, if you're not a big company with 50 million or more that you can park in a margin account, you're not having a big inventory, first and foremost. The cost of running this business because of things like that has become exponentially higher with insurance. Insurance say, well, metals have gone way up, and you know, how are you going to protect that and insure that within the vault and all, coinciding with the stupid margin increases to the nth degree to knock the speculators up. So you are a refiner. So, you know, companies like mine have big enough bankrolls to buy this stuff and stockpile and hang on to it, right? And hedge it. The cost of hedging just went way up. But if you're a mid-sized company or a small-sized company and you don't hedge, you offload it right away. Well, with the volatility we've seen in the market where, you know, $1 moves used to be a lot. Now we're seeing huge moves. You have to be way back of spot if you're not hedging it, because you could take in $100,000 worth of stuff and it moves.
Another reason this drop has seasoned investors paying attention is because the silver market has been running a structural deficit for years now, and that deficit is quietly growing into one of the most important forces in the entire metals market. Most people only look at the price chart, but the real story is happening in the balance between how much silver the world produces and how much it consumes every year. Right now, the numbers tell a very clear story. Global silver demand continues to exceed total supply, and analysts expect the market to remain in deficit again this year, marking the 6th consecutive year where consumption outpaces production. That means industries, investors, and governments are collectively using more silver than miners and recyclers are able to bring to market. When that happens, the difference has to come from existing above-ground inventories, and those inventories are not infinite. This is the kind of dynamic that doesn't immediately show up in dramatic price spikes, but it steadily builds pressure inside the market. Each year that demand exceeds supply, a little more silver is pulled out of global stockpiles. At first, the market barely notices because those inventories act like a buffer. But as the deficits continue year after year, that buffer gradually shrinks. Think of it like draining a reservoir. At the beginning, there is plenty of water available, so nobody worries about it. But if more water keeps leaving the reservoir than entering it, eventually the level begins to fall. At some point, the shortage becomes impossible to ignore. Commodity markets work in a very similar way. Long periods of supply deficits quietly tighten the market until suddenly prices have to move sharply higher to restore balance. What makes the current situation even more interesting is that the expected increase in supply is extremely modest. Global silver production is projected to grow only slightly, with mine output increasing by around 1%. That's a very small increase compared to the scale of demand coming from both industrial users and investors. Recycling is expected to rise as well, but even that increase is unlikely to fully close the gap between supply and demand. This imbalance is exactly why so many experienced investors are not worried about short-term volatility. They understand that when a commodity is facing persistent supply deficits, price corrections often create opportunities rather than warning signs. The underlying pressure in the system continues building regardless of what happens on the chart over a few days or weeks. And that's why the $10 drop is being interpreted so differently by different groups of investors. To short-term traders, it looks like a failed breakout. But to those who are studying the deeper supply dynamics of the silver market, it looks more like a temporary shakeout in a market that is still facing a very serious structural shortage. But supply deficits alone don't drive a market into a full-blown bull run. For that to happen, you also need a powerful wave of investment demand entering the market at the same time. And right now, there are growing signs that investors around the world are starting to move back into silver in a big way.
Said gold will be a higher share of reserves 5 years from now, all the central banks. And, to me, this isn't gold hype from the World Gold Council. This is the fact that the world is hedging against the dollar system. And I think that is what is happening. When you look at you look at the amount, there was an interesting article I read that talked about energy and infrastructure, where China every year is building onto their energy infrastructure more so than our entire grid, which is 50, 60, 70 years old, whatever, that is in a state of disrepair. The amount of energy you needed to build electricity and to build it that will work for AI and the needs of a globalized or of a country that is digital, that is using AI, that is looking at a system that is broken and in disrepair. If we want to reshore manufacturing, if we want to be competitive, we need to start also by fixing the power supply and upgrading it. There is no way of doing that, but where's the money come from? Right? So we're already broken insolvent. So we're going to print more money. Again, all of the things we're looking at going forward speak to the decline of the value of the U.S. dollar. That's the bottom line as far as I'm concerned. The U.S. dollar is in very, very big trouble ultimately because we don't have enough money to do things like build out the grid, to build out our infrastructure when China is doing that nonstop with their trade surplus. And we're not. And China has the energy advantage and more power and a newer grid, and we don't. And I think we're in a competition that we can't afford to lose by rebuilding the grid, reshoring industry, keeping up with the AI tech costs, involved with all this costs trillions. And where's it going to come from? It's going to come from abandoning the reserve status, as we've talked about, as I've screamed. Now, I might be the only one saying this over and over and over again, that I really believe that we are going to softly default on the reserve status in order to reshore things. And I've gone into that thesis enough. I don't need to go into it again. But I think the bottom line with all of this stuff is stop looking at the noise, at the daily moves. Look at the big picture. The big picture is that the dollar is going to be what is going to be sacrificed in order to compete with the rest of the world, whether it be to reshore, whether it be to rebuild the grid, whether it be to keep up with AI, whether it be to bring back manufacturing. And so gold and silver will be the benefactor of this. And when you see the amount of huge money over the last 8, 16, 17 months that has stood for delivery, that's all you need to see. They're positioning, and they're continuing to do so. And if it's that important for the governments to do so, they won't make it easy for the rest of us. The volatility, the counterintuitive rhetoric, all of this stuff, that's all part of what they've done forever. And as the stakes get higher, so too will the volatility. And the ability for those to hang on will be less and less and less. Don't let go. Don't sell your metal. It's all I can tell you is that this is not over, not even close. This is the volatility one would expect in a shift like this. And big money, big stakes, big volatility.
One of the biggest signals supporting silver right now is something that hasn't received nearly as much attention as it should, and that's the sudden resurgence in investment demand. Because while the price correction shook confidence in the short term, many investors are actually increasing their exposure to silver rather than stepping away from the market. In fact, analysts are projecting that physical investment demand for silver could rise dramatically this year, climbing roughly 20% to around 227 million ounces, which would mark the highest level in 3 years. That kind of surge doesn't happen randomly. It reflects a growing shift in investor behavior as uncertainty continues to ripple through the global economy. Think about the environment we're operating in right now. Governments around the world are struggling with massive debt levels. Inflation continues to erode purchasing power, and geopolitical tensions remain elevated across multiple regions. In times like this, investors naturally begin searching for assets that exist outside the traditional financial system. Precious metals have historically filled that role, and silver is often the metal that attracts the most attention once a broader precious metals cycle begins. What's particularly interesting about the current situation is the return of Western physical investment demand, which had been declining for several years. Now that silver has delivered strong price performance and re-entered the spotlight, investors in North America and Europe are beginning to re-engage with the market. As uncertainty surrounding economic policy and central banks continues to grow, physical silver is once again being viewed as a form of financial insurance. At the same time, the global investment ecosystem around silver is expanding. Exchange-traded products backed by physical silver now hold an estimated 1.31 billion ounces, representing a massive pool of capital that can influence the market when investment flows accelerate. When large numbers of investors decide to move capital into these products simultaneously, it can place enormous pressure on the underlying supply of metal. This is where the situation becomes particularly powerful. Remember, the silver market is already operating with a supply deficit, so when investment demand begins rising sharply on top of that deficit, the pressure on the system multiplies. The market is forced to pull more silver from already strained inventories, tightening the physical supply even further. And this is exactly why experienced investors often accumulate during periods of volatility. They know that the biggest gains in commodities rarely happen when everything feels comfortable and predictable. They happen when the market is uncertain, when prices pull back, and when fear creates opportunities for those willing to look beyond the short-term noise. But investment demand is only one side of the story. Because even if investor interest continues to rise, the silver market is also being driven by another massive force that is only just beginning to unfold, a force tied directly to the technologies shaping the future of the global economy. And once you start looking at the scale of industrial demand building across multiple sectors, you begin to see why the long-term outlook for silver could be far more powerful than most investors realize.
Not real metal. And real demand is showing up in Shanghai, and price discovery is shifting there. It's leaving London, it's leaving New York, and as long as the Western paper market stays disconnected to Shanghai like it is now, the physical silver will keep getting pulled out of the West and sent to where it's valued. And look, the scary part, it's even getting tight in Shanghai with premiums starting to blow out. And I think that's why, to me, the forwards and the futures are starting to feel almost undeliverable for a lot of people. This is why you're seeing backwardation, where the market makers are having a hard time sourcing metal. They can't hedge easily. Their exit becomes the move, maybe, right? And getting out. And I think that's what you see every time they smash the hell out of it. Are they doing it to get out along with stand for delivery? Are they doing it to extricate themselves from these stupid short positions that used to work before this was all, I think, figured out? Where, there are some very sophisticated traders around the globe, as I've been saying since 2020 on your show. The central banks have figured it out of the global south. Stand for delivery slowly. Don't do it too fast. Everyone says, why don't they just throw trillions of dollars at? Because you kill yourself. You cut off your nose to spite your face. They've been masterful at draining the exchanges all around the world. And that slow, insidious, little by little part, people can't handle. It's too monotonous. It's too slow. It's a nothing burger. But as you can see, we're getting to the point where they're running out of available silver to deliver. And that, to me, is all you need to see, on top of Who's been standing for delivery every single month, month over month over month over month over month for billions and billions and billions of dollars? They don't do this for the hell of it. What you see right now is just the volatility meant to throw the rest of us off the scent, off the trail, and join the highest influx into global U.S. equities in history. They want the rest of us in the pen with the rest of the sheep. At the same time, you got billionaire David Einhorn. I don't know if you saw that article, but he thinks that gold is well on its way to becoming the world's ultimate reserve asset. This is a guy that runs one of the biggest hedge funds in the world, and he's saying that it's already replacing treasuries, as we've talked about for the last several years, as central banks' reserve asset, because the confidence in this system, both fiscal and macro outlook, is getting worse. And, you know, when you look at China telling their banks to scale back treasury exposure, it's a signal to me that the shift for gold is far greater than the shift is for treasuries. They're selling them, and we've seen almost 900 tons bought in 2025 by the central banks, which is huge. So anyways, bottom line is, with both gold and silver, the fundamentals couldn't be stronger, but the volatility, I think, will continue to knock those who don't have strong fingertips off the back of the bull, who wants to take as few of you along for the ride as possible. All bull markets do that.
Industrial demand for silver is one of the most powerful forces shaping the future of this market, and it's something many investors underestimate because they still think of silver primarily as a precious metal. But in reality, silver is also one of the most important industrial metals on the planet. Its unique physical properties, particularly its unmatched electrical conductivity, thermal conductivity, and resistance to corrosion, make it essential in technologies that power the modern world. And right now, those technologies are expanding at an extraordinary pace. Take solar energy, for example. Solar photovoltaic panels rely heavily on silver to conduct electricity efficiently. As countries push aggressively toward renewable energy targets, solar installations are accelerating around the world. Over the past decade, solar has grown from a relatively small consumer of silver into one of the largest sources of industrial demand. In fact, the solar sector alone has grown from using around 11% of global silver demand in 2014 to roughly 29% by 2024. That kind of growth illustrates just how deeply silver has become embedded in the global energy transition. And the expansion isn't slowing down. Governments across Europe, North America, and Asia are committing enormous resources toward building renewable energy infrastructure. The European Union alone has set targets to deliver at least 700 gigawatts of solar capacity by 2030. Achieving those targets will require vast quantities of silver because the metal plays a critical role in the photovoltaic cells that convert sunlight into electricity. Then there's the electric vehicle revolution. Electric vehicles require significantly more silver than traditional internal combustion engine cars because of the complex electrical systems inside them. Silver is used in battery systems, power electronics, charging infrastructure, and numerous electronic components that manage the flow of electricity throughout the vehicle. As EV production ramps up worldwide, the automotive sector is expected to steadily increase its silver consumption in the years ahead. What makes this industrial demand especially important is that it tends to be relatively inelastic. In other words, many of these industries cannot easily substitute another material for silver without sacrificing efficiency or performance. When a metal has that kind of unique functionality, demand remains strong even when prices rise. And that's exactly why analysts increasingly describe silver as a metal sitting at the crossroads of two powerful trends. On one side, you have the traditional role of silver as a monetary and investment asset, attracting capital during times of economic uncertainty. On the other side, you have a rapidly expanding technological economy that depends on silver to build everything from renewable energy systems to advanced electronics. When those two forces operate, Simultaneously, something very unusual can happen in commodity markets. Investment demand and industrial demand begin reinforcing each other. Investors buy silver because they see rising industrial consumption. Industrial users scramble to secure supply because investors are accumulating the metal. That kind of dynamic doesn't develop overnight, but once it begins to take hold, it can drive price movements that few people expect. And right now, many analysts believe we are only in the early stages of that process, because beyond solar panels and electric vehicles, there's another rapidly expanding sector that could quietly become one of the biggest drivers of silver demand in the coming decade.
Do the math. If demand for delivery spikes, COMEX has two options: either drain registered inventory very fast, which would be, I guess, a very serious drawdown, or you have the price of immediacy increases, where you have forced incentives. Premiums will increase, exchange for physicals will increase. They will try and get people to roll to May by incentivizing cash settlements with a premium, anything to keep anything to keep metal from leaving. And in my opinion, this is how the stress shows up. It's not in price, but it's in the delivery mechanisms and the delivery mechanics. And when the paper claims tower over the deliverable silver, I think the market is calm until it isn't. And so I think really what you're looking at is even a portion of this stands for delivery. 20% stands for delivery. You're talking, 60 million ounces of the 90 million. This is a problem. And so I think that's, to me, the biggest issue right now. What I'm watching is we'll see what happens over the next 10 days. At the same time, you still have this big $10 premium in Shanghai over the Western price. That this arbitrage is not going away. They're continuing to incentivize the people here in the West who have the ability to buy cheap, $75 or whatever, and sell it for $85 in China. A lot of people say, well, what about the difference in price is the tax. The VAT tax, right? Not tariffs, that there's a VAT tax, which is true, but it's not true, right? These are people who are not quite understanding the mechanics. The VAT tax is really there, but it's the responsibility of the recipient, because when metal is delivered to Shanghai and you get that $10 arbitrage spread, you deliver 50 million ounces at $10, you just made $500 million. That VAT tax is the responsibility of the recipient when it leaves the Shanghai exchange. So it's not paid until it leaves. If it stays there, there is no tax. So in other words, that arbitrage is significant enough at this point for a $10 premium plus like a 13 or 14 or 15% tax. They don't care. They want the metal. And so this is all, I think, noise. You have to see the big picture. You have to relax, see the big picture, understand it for what it truly is. And I think, yes, the volatility is enough to freak a lot of people out. But look, silver is the canary in the coal mine. And I think it's exposing a paper market built by banks that trade credit.
Beyond solar panels and electric vehicles, another powerful force is quietly emerging that could dramatically reshape silver demand over the next decade, and that force is the explosive growth of data infrastructure and artificial intelligence. As the digital economy expands, the world is building an enormous network of data centers, high-performance computing facilities, and advanced electronics that all rely heavily on silver's unique properties. Every time you send a message, stream a video, or interact with an AI system, massive data centers are working behind the scenes to process that information. These facilities require vast quantities of electrical connectors, circuit boards, switches, and cooling systems, all of which depend on highly conductive materials. Silver plays a crucial role in these systems because it conducts electricity better than any other metal on Earth. When enormous amounts of data are moving through servers every second, even small improvements in conductivity can significantly improve performance and efficiency. This is why silver is becoming increasingly important in the infrastructure that powers cloud computing and artificial intelligence. Modern data centers require components that can handle extremely high electrical loads without losing efficiency or overheating. Silver-based materials are used in connectors and circuits to minimize energy loss, while silver thermal materials help regulate heat in densely packed server environments. Without these properties, many high-performance computing systems simply wouldn't operate as efficiently as they do today. At the same time, the scale of this infrastructure expansion is staggering. Technology companies around the world are investing hundreds of billions of dollars into building new data centers to support artificial intelligence, cloud services, and global digital connectivity. As AI adoption accelerates, the demand for processing power is growing exponentially, and that means more hardware, more electronics, and ultimately more silver embedded throughout the system. What makes this trend particularly powerful for the silver market is that it operates alongside the other major demand drivers we've already discussed. Solar installations continue expanding as countries pursue renewable energy goals. Electric vehicle production is climbing as governments push toward electrified transportation. And now, on top of those trends, the digital economy is constructing an entirely new layer of global infrastructure built around data and artificial intelligence. When you step back and look at the full picture, silver is positioned at the center of multiple technological revolutions happening at the same time. Few materials on Earth are as deeply integrated into so many different sectors of the modern economy. And because silver's physical properties are so difficult to replicate, many of these industries have limited options when it comes to substitution. That's why the industrial side of the silver market is becoming such an important part of the long-term story. Even if investment demand fluctuates in the short term, the underlying technological demand continues expanding year after year. Every new solar farm, every electric vehicle factory, every AI data center quietly adds another layer of demand for silver. And when this relentless industrial demand begins colliding with the supply constraints we discussed earlier, it creates a situation that commodity markets rarely experience. A market where demand is rising across multiple sectors simultaneously while supply struggles to keep pace.
$10 an ounce, and the next day, and you're way down. Well, if you're taking large amounts in, you go out of business. So the small, mid-sized companies who aren't hedging, well, they have to be way back of spot because of this environment. Normally, they would give it to the refiner and get spot, or a hair under, whatever, but now the refiners won't take it because the refiners have to hedge theirs. So, if the refiners take in $50 million worth of product, they'll hedge $50 million worth of product on COMEX, right? Market neutral. Well, it takes time to break down the doré, to break down the junk silver, melt it down into pure silver, into shot, and then refine it into bars and rounds, or the flatware where the knives are, the blade is stainless steel, the handle is plaster, a little bit of sterling silver around the handle. It takes time to break that down, snap off the blade and break the silver off the handle, and all. It's labor intensive and it takes time. Well, for 2 months, the price of silver was going up so fast and the margin requirements so fast, all the refiners got margin called. And they're like, we can't do this. We take in any more, we're going to go out of business. We're getting margin called on our short position to offset our inventory, but we can't even melt the stuff down yet. And we're getting margin called because of it. The entire industry has been gummed up because of margin increases in particular. And it has reverberated through the entire industry, largely because the refiners, which would provide a great source of liquidity to the industry, aren't anymore. They're not taking any business. And so when you look at the increase in costs on those that use margin and hedge rather, or the risk for those that don't, it's created an environment that no one has ever seen before. Now, I don't think this will last. I just think that this is an environment that it's kind of an outlier. I would not sell junk silver right now. It's the best value, period. Buy it at spot. It is the best value I've ever seen. And remember, in a period of great stress, 2020 through 2024, we would have paid you $9 to $10 over spot for any amount of junk silver you would sell. So it was the best performing asset in silver other than Silver Eagles for 4 years. It's just the fluidity and craziness of the times that we live in, which, after what we've lived through the last 4 or 5 years, nothing should surprise you anymore. This is not a new rule. I think this is an exception to an old rule. And hang tight. This will all, once it all clears through the system, once the system ungums up.
Just before we get going, we just launched the official Silver News Daily Telegram. To kick things off, we're running a 10-ounce silver giveaway. Yes, real physical silver, not a voucher, not digital credits, actual bullion. This Telegram will be our new home for real-time silver discussions, market insights, collection picks, and everything precious metals. It's where the community truly comes alive. Here's how to enter the 10-ounce silver giveaway. Be subscribed to Silver News Daily on YouTube. Turn on the notification bell. Comment 10-ounce giveaway on 3 separate videos. Be an active member of the Telegram group and say hi. Once we hit 500 active Telegram members, we'll pick one lucky winner to receive 10 ounces of silver shipped directly to you. So get in early, stay active. Another critical part of the silver story that rarely gets discussed is the reality of how difficult it is to actually increase supply. When demand begins rising quickly in commodity markets, people often assume miners will simply produce more to meet that demand, but the silver industry doesn't work that way. And that's one of the reasons the market can tighten much faster than many investors expect. The first issue is that most silver isn't mined from primary silver mines. A large portion of global silver production actually comes as a byproduct from mining other metals, such as copper, lead, and zinc. That means silver output is often tied to the economics of completely different commodities. Even if silver prices rise dramatically, many mining companies cannot immediately increase production because their operations are designed around extracting those other metals first. Building new mines is also an extremely slow process. From discovery to production, a new mining project can take 10 years or more to fully develop. Companies must explore the deposit, conduct environmental studies, secure permits, build infrastructure, and construct the processing facilities required to extract the metal. Even when prices are rising, that entire pipeline cannot move quickly enough to respond to sudden increases in demand. Right now, the outlook for global supply reflects this reality. Analysts expect total global silver supply to increase only slightly, growing by about 1.5%, while mine production itself is projected to rise by roughly 1% to around 820 million ounces. These are relatively small increases compared to the scale of demand that continues building across investment and industrial sectors. Recycling does provide an additional source of supply, and higher prices tend to encourage more recycling activity as people sell scrap silver back into the market. But even here, the increases are limited. Recycling is expected to grow by roughly 7%, which helps somewhat, but still does not eliminate the broader supply deficit the market has been experiencing. This is why many analysts say the silver market is gradually becoming dependent on above-ground inventories to meet demand. When production and recycling cannot keep up, the market must draw from existing stockpiles of physical silver that have accumulated over time. Those inventories effectively act as the buffer that keeps the market functioning during periods of shortage, but buffers only last so long. If demand continues exceeding supply year after year, those reserves slowly decline. At some point, the market begins to notice that the available pool of metal is shrinking. When that realization spreads across investors, manufacturers, and traders simultaneously, the result can be extremely rapid price movements as everyone competes for the remaining supply. And this is why the recent $10 drop may ultimately prove far less important than many people think. Short-term volatility can move prices dramatically in the moment, but it doesn't change the deeper structural limitations facing silver production. Because when you combine limited supply growth with rising investment demand and expanding industrial consumption, you begin to see the kind of conditions that historically lead to powerful commodity bull markets. But there's another indicator experienced precious metals investors are watching very closely right now, an indicator that has predicted some of the biggest silver rallies in history. And that signal comes from the relationship between gold and silver themselves.
Already changed, to be honest with you. It should have. And look, if you want to know the truth, the only way that you ever really get ahead in things is to buy things that are cheap and undervalued when they're on sale. You don't go into Nordstrom's to buy your kids a new wardrobe for school and say, gosh darn it, everything's on sale. And that's what we're saying here. This stuff is on sale. Look, I remember 2007, 8, and 9 when premiums on that stuff were 70, 80, 90% or higher, even from circulated grades, over $1,000 spot price. I flew all around America for 2 years and told people who had bought nothing but numismatics from us, sell us your numismatics and go into bullion. I would call a guy like you and say, Dunnigan, I sold you 1,000 MS-62 Liberties over the last 10 years. I'm flying out to your house and you can't say, no, I'm bringing 1,800 Gold Eagles with me. And I did that for 2 years. It's the best trade I ever did for my clients ever. I became Diamond Elite on Delta, flew everywhere, and I would exchange these. There were auction galleries bidding massive premiums for pre-33 stuff. Look, when you see the largest inflows in the history of the stock market ever right now into equities, at the same time, you're seeing institutional investors leave quietly, and the big money, the Buffetts and those Bezos and the Zuckerbergs, quietly leave and start to pare down exposure. And at the same time, who's standing for delivery for all of the metal on COMEX? It tells you that we're seeing a shift that the public hasn't taken part in yet. And it won't take very much interest from the public to push these premiums and all this stuff parabolic again. We're not there yet. So I guess it's one of these deals that, no one complains when it's the opposite. And when things are on sale, people get upset. I get it. But this is way above Miles Franklin's price grade. These are the market makers.
One of the most powerful signals precious metals investors watch is the relationship between gold and silver, something known as the gold to silver ratio. This ratio simply measures how many ounces of silver it takes to buy 1 ounce of gold. But historically it has acted as a powerful indicator for when silver is dramatically undervalued relative to gold. Right now, that relationship is sending a signal that many experienced investors are paying very close attention to. Throughout history, whenever the ratio becomes stretched and then begins to compress, silver tends to move far more aggressively than gold. In other words, once silver begins catching up, it rarely moves slowly. It tends to explode higher. We've seen this pattern play out multiple times in the past. In 1980, as gold surged during the inflation crisis of the late 1970s, silver initially lagged behind. But once momentum shifted, silver rocketed from under $6 to nearly $50 in a matter of months. Then again, during the early 2000s bull market, gold led the charge higher first. Silver followed later, but when it finally did, the gains were dramatic. Between 2008 and 2011, silver surged from roughly $9 to nearly $50, delivering one of the most explosive rallies in the entire commodities market. What makes the current environment so fascinating is that we are once again seeing gold lead the precious metals complex. Gold has been breaking record highs as central banks accumulate massive reserves and investors around the world seek protection against currency instability and geopolitical uncertainty. Silver, meanwhile, has only recently begun to break out of its long consolidation period. And historically, that exact setup has been the moment when silver begins to outperform. When gold establishes strength first, it often acts as the signal that capital is moving back into hard assets. Once that shift becomes obvious, investors start looking for assets that are still undervalued relative to gold. That's when attention begins shifting toward silver. Recently, the gold to silver ratio has already begun moving toward levels that historically signal stronger silver performance ahead. At one point, it even dropped below 50, a level not seen since 2012, indicating that silver had started to regain strength relative to gold as the metals market heated up. When this ratio begins compressing during a precious metals bull cycle, the implications can be enormous. Because if gold continues climbing while the ratio tightens further, silver doesn't just follow along for the ride. It often accelerates at a much faster pace. This is one of the reasons some analysts believe silver could dramatically outperform gold in the years ahead. If the historical pattern holds true and silver begins closing the gap more aggressively, the move could surprise investors who are only watching the daily price fluctuations instead of the broader relationship between the two metals. And when you combine that historical pattern with everything we've already discussed, the supply deficits, the surge in industrial demand, and the growing wave of investment interest, you begin to see why some analysts are making predictions that sound almost unbelievable. Because the conversation around silver isn't just about returning to old highs anymore. Some experts believe we could be entering a period where the metal moves far beyond anything the market has seen before. And that's where the discussion around extreme long-term price targets begins to enter the picture.
Who are saying this is the premiums that we see right now, which in both cases, whether it be pre-33 or the pre-65 silver, I've never seen in 36 years. Never. And if I look at what has made me successful in terms of individual trades, it's always been identification and exploitation of price anomalies. You want to exploit a price anomaly, buy pre-33 gold, buy junk silver, you're exploiting a price anomaly. Now, does that mean that, what's the old adage? Markets can stay irrational longer than you can stay solvent. It's true here too. But I'll tell you, in 36 years, in almost 15 billion in sales, I have never, and I mean never, seen this with Numis and this with junk silver. So for me, if I'm looking for the very best value, that's where it is. I don't make any statements about, yes, it's gonna clear up in 6 weeks. I don't know when it will, but history says that the further away you get from established averages, the greater the magnetism that regresses you to the mean, and that's where we are. These are way outside of normal. And on the low side, where the reason people don't buy numismatics, we've always been told the premiums are too high. Well, now there's no premium, so why bitch about it? Yeah, if you own it, sure, you're upset because, well, it's not performing like you think it should. Well, you have two choices. Switch to gold bullion if you want, or hold on and know you have a massively undervalued asset in terms of its premium compared to where it's been literally my entire career, which goes back to 1989, 1990. I've never seen it. Is it an outlier? I think so. Is it a new reality? I doubt it. But who knows anything anymore in this crazy world we live in? Why fight it? If you're looking for the best value, that's where it is. If you're looking for the ability to gain upside potential when the public wakes up, that's where it is.
As the silver market continues evolving, a much bigger conversation has started to emerge among analysts, investors, and industry insiders. It's a conversation about where silver could ultimately go if all of the forces we've discussed continue building at the same time. Because when you combine structural supply deficits, accelerating industrial demand, growing investment interest, and the broader instability in global financial systems, you begin to see why some experts are discussing price targets that would have sounded impossible just a few years ago. Throughout history, silver has had a tendency to dramatically overshoot expectations during major bull markets. When momentum builds, it often moves far beyond what traditional valuation models would suggest. Part of the reason is the relatively small size of the silver market compared to other financial markets. The total value of above-ground investment-grade silver is tiny compared to global stock markets, bond markets, or even the gold market. That means it doesn't take a massive shift in global capital to create very large price movements. If a meaningful portion of institutional money begins rotating into silver, the effect could be enormous. Pension funds, hedge funds, and sovereign wealth funds collectively manage trillions of dollars. Even a small allocation shift toward physical silver or silver-backed financial products could place tremendous pressure on a market that is already struggling to balance supply and demand. There is also the monetary side of the equation to consider. Throughout thousands of years of history, silver has functioned not just as an industrial metal, but also as a form of money. In periods when confidence in paper currencies begins to weaken, precious metals often re-enter the conversation as alternative stores of value. Gold usually leads that transition, but silver often follows with even greater percentage gains because of its smaller market size and higher volatility. This is why some analysts believe silver could eventually move far beyond previous highs if a full monetary shift begins taking place. The idea of triple-digit silver once seemed unrealistic, yet the market has already crossed that level. Now, the conversation among some of the most bullish voices in the precious metals space has shifted toward much larger long-term possibilities. In extreme scenarios involving currency instability, major financial crises, or dramatic revaluations of hard assets, projections of several $100s per ounce or even higher have entered the discussion. Of course, these kinds of projections depend on many factors and would likely unfold over a long period of time. Markets rarely move in straight lines, and silver in particular is known for its volatility along the way. But what makes the current moment so interesting is that multiple powerful forces are aligning simultaneously, forces that historically have preceded some of the most dramatic commodity rallies ever recorded. And that brings us back to the present moment, to the $10 drop that shook the market and created so much uncertainty among investors. Because if the larger forces shaping the silver market continue strengthening, that sudden correction may not be remembered as the beginning of a decline. It may be remembered as the moment that gave investors one last opportunity to enter the market before the next phase of the silver story truly begins.
In this industry should understand what you just said, which is very eloquent and to the point. Anyone who owns gold and silver is a contrarian, and we were all wrong for a while, and all of a sudden we're very right. Maybe not on all of the products haven't worked out the way you thought they would or the way that I thought they would. Doesn't matter. I mean, I think the difference between the people who own metal and listen to this show versus the mainstream is that we all have the ability to see maybe outside the box, and to not only see outside the box, but take action upon what we see outside the box. That is a rare, rare, rare quality. And you all know that, because try to talk about any of this stuff to one of your friends that's inside the box for 60 seconds, watch their eyes roll into the back of the head, or watch them, whatever, you again and this crap again, or maybe they try and talk to you and it just doesn't go anywhere. The point of it is that contrarians have a lonely road. And, I think that being a contrarian in investing is what makes people truly successful. This is why there is an entire school of investment theory, wave theory, Contrarian Elliott wave, which measures the emotions cumulatively of the herd from, greed and exuberation, irrational exuberation, down to fear and panic and, oh my God, what now, what? The people who stand outside, who are away from that, can see things a little bit more clearly. They're the ones who benefit. But we all still have that human emotion in us where we want to kind of, gravitate. Did I make the wrong decision? Should I go to the herd? Don't question your motivation. And this market is insane right now. And it's insane because they're trying, I think the banks, that the CME group is trying very hard to hang on to what is something that is very dangerously slipping away from them, and that is the ability to control the price. And they're doing so by things like raising margin exponentially to the highest ever to shake out any of the traders who have multiple contracts on margin. Well, that affects this industry. It affects the refiners. It affects everything all the way down, the unintended consequences, perhaps. And then you throw into it some of the Asian AI channels that are throwing out misinformation at the same time. I mean, you wonder, how coordinated is this stuff? How deep does it go? You can let your mind wander a little bit. Fine line between conspiracy and reality, but the bottom line is the fundamentals I see, nothing's changed. They're getting stronger by the day. So as far as numismatics go, I wouldn't sell them. and hang on to them. In fact, if you're looking for real value, you're probably going to find it there. Low-grade numismatics, from circulated to 64 grade. That's the prime spot. And if you want the best buy I've ever seen in my career in silver, it's in pre-65 silver. Could it stay horrible bid prices longer than we think? Sure it could. It already has, but I don't know. I still think that's how you get ahead, and that's how you give yourself a chance for exponential profit and appreciation, is buying things that are undervalued, that never have been undervalued like this, but now all of a sudden are.
So when you step back and look at everything that's unfolding in the silver market right now, the recent $10 drop starts to look very different from the way it first appeared. What initially looked like panic may actually be something far more familiar to anyone who has studied past commodity bull markets. A violent shakeout that forces weak hands out of the market just as the underlying fundamentals continue getting stronger. Because the deeper story hasn't changed. The silver market is still running a structural supply deficit that has lasted for years. Industrial demand continues expanding as solar energy, electric vehicles, artificial intelligence, and global data infrastructure all require increasing amounts of the metal. At the same time, investment demand is beginning to return as economic uncertainty pushes investors toward tangible assets that exist outside the traditional financial system. And when you combine those forces with the historical behavior of silver, during precious metals bull markets, it becomes clear why experienced investors are paying so much attention to this moment. Silver has never been a market that moves slowly or predictably. When momentum finally builds, it often accelerates faster than anyone expects. History has shown again and again that once silver begins catching up to gold and supply constraints start tightening, the resulting rallies can be explosive. That's why many seasoned investors see this pullback not as the end of the move, but as the kind of opportunity that rarely appears during the early stages of a major cycle. A moment when volatility creates fear in the short term, while the long-term forces driving the market continue building quietly beneath the surface. If the trends we've discussed continue developing, tightening supply, expanding industrial demand, rising investment interest, and a global financial system facing increasing uncertainty, then the bigger silver story may only be getting started. And if that's the case, the sudden drop that scared the market could eventually be remembered as the moment that gave investors one last low entry point before the next phase of silver's rise begins. If you want to stay ahead of major developments in the silver market and understand the forces shaping the future of precious metals, make sure to subscribe and stay connected with the channel so you never miss the next discussion. And as always, remember that this content is for informational purposes only and is not financial advice. Always speak with a qualified professional before making any financial decisions.